When people think about the fall of Rome, they imagine barbarians storming the gates, legions collapsing, or emperors poisoned in marble palaces. But empires don't crumble just from outside attack. They rot from within. And one of the most corrosive forces is always money. Rome didn't just fall because of invasions or corruption. It fell because its currency collapsed. And the lessons from that collapse still apply to every modern economy that thinks it can play games with money and get away with it. Let's set the stage. For centuries, Rome's economic backbone was the silver denarius. First minted around 211 before Christ, it was nearly pure silver, trusted across the empire and beyond. Roman soldiers were paid in it, merchants demanded it, and ordinary people stored their wealth in it. The denarius wasn't just money, it was confidence in metal form. The empire's power and the coin's value were linked. As long as people believed in Rome, they believed in its money. Trade routes stretched from Britain to Egypt, from Spain to Syria, all bound together by a common currency that everyone accepted. The denarius made Rome's vast empire manageable, turning distant provinces into a single economic zone where goods, services, and taxes flowed smoothly. But running an empire is expensive. Legions had to be paid, roads and aqueducts built, and wars financed. By the 2nd century after Christ, Rome was stretched thin, defending borders against Germanic tribes, Parthians in the east, and unrest within. Tax revenues could not keep pace with military costs. So emperors turned to an age-old trick, debasement. Instead of taxing citizens more, always unpopular, they reduced the silver content in the denarius. It seemed like a perfect solution. The coins looked the same, weighed roughly the same, and bore the emperor's face just as before. Who would notice a little less silver? The numbers tell the story. Under Emperor Augustus, who ruled at the dawn of the empire, the denarius contained about 95% silver. By the reign of Caracalla in the early 3rd century, it had dropped to around 50%. By the time of Emperor Gallienus in the mid-3rd century, the denarius contained less than 5% silver. A coin once made of solid metal had become a disc of bronze coated with silver wash. Each emperor who needed quick money debased a little more, thinking they could get away with it just one more time. The progression was slow at first, then catastrophic. The people could see and feel the difference. Coins began to flake, exposing the base metal underneath. Merchants started weighing coins instead of counting them, checking their bite marks to test for silver content. Inflation followed. Prices rose because money was no longer anchored to real value. A measure of wheat that once cost a single denarius might suddenly cost dozens. This was not abstract theory. It destroyed the lives of ordinary Romans. A soldier who once fed his family comfortably on his salary found himself struggling to buy bread. Pensioners who had saved denarii for retirement watched their life's work evaporate. Landlords demanded payment in goods instead of worthless coins. Soldiers demanded higher pay to cover rising costs, which forced emperors to debase even more to meet payroll. Merchants stopped accepting debased coins, preferring barter or payments in gold. Local economies reverted to direct trade because the currency was no longer trusted. Farmer traded grain directly for tools. A blacksmith exchanged horseshoes for cloth. The sophisticated monetary economy that had unified the empire began to fracture into thousands of local barter networks. And the more confidence eroded, the more emperors struck cheaper coins, hoping volume would replace value. It was a vicious cycle, the same cycle that has repeated in countless inflations since. The crisis peaked during the so-called crisis of the 3rd century. Between 235 and 284, after Christ, Rome suffered nearly 50 years of chaos, invasions, plagues, civil wars, and economic collapse. In those 50 years, over 50 emperors claimed the throne. Most were murdered by their own soldiers or rivals. The average reign lasted less than 2 years. Emperors rose and fell at dizzying speed, sometimes reigning only months before being assassinated. Behind the political drama was a broken financial system. Taxes were demanded in coins worth less and less. Farmers abandoned their lands rather than pay taxes that exceeded what they could earn. Trade networks fractured as merchants refused Roman currency. The empire's vast infrastructure, roads, aqueducts, public buildings, began to decay for lack of funds. Soldiers went unpaid and turned to looting the very provinces they were meant to protect. None of it worked. One emperor, Diocletian, tried to stop the bleeding. In 301 after Christ, he issued the edict on maximum prices, fixing the cost of over 1,000 goods and services, from grain to labor wages. The edict listed everything: how much a teacher could charge, what a scribe should earn, the price of a pound of pork or a pair of boots. Violators faced death. It was one of history's most comprehensive attempts at price control. The edict was a disaster. Prices couldn't be controlled by decree when the money itself was worthless. The black market exploded. Goods vanished from official markets and appeared in secret trades at real prices. Official trade all but collapsed as merchants hid their inventory rather than sell at losses. People learned quickly that the law couldn't make a broken coin whole. Within a few years, the edict was quietly abandoned, a monument to the futility of fighting economic reality with political force. Eventually, Rome abandoned the denarius altogether. Constantine the Great introduced the solidus, a gold coin of consistent purity, around 312 after Christ. Unlike the debased denarius, the solidus maintained its weight and purity for centuries. It restored some stability and lasted for centuries in the Eastern Roman or Byzantine Empire, becoming the most trusted currency in medieval Europe and the Middle East. But by then, the Western Empire was already fatally weakened. The debasement of the denarius had hollowed out Rome's economic core. Armies could no longer be sustained on worthless coins. Trade networks had broken beyond repair. Tax collection had collapsed. And most critically, trust was gone. Once people stopped believing in Rome's money, they stopped believing in Rome itself. The fall of Rome was not a single event, but a long unraveling, and currency collapse was one of its sharpest threads. What does this mean for us today? It means that the destruction of money is always the destruction of empires. Rome thought it could trick its people by issuing coins that looked the same, but contained less real value. Modern governments think they can do the same by printing paper, manipulating interest rates, or inflating away debts. The technology has changed, from silver shavings to digital zeros on a screen, but the mechanism is identical, and the outcome is always the same. The people pay the price, wealth is destroyed, and trust collapses. Rome learned this lesson the hard way, and if we ignore it, so will we. History didn't stop teaching after Rome. Every major inflationary crisis since then has repeated the same pattern. Governments debase money to cover their costs. Elites protect themselves with real assets, and ordinary people are left broke. The Roman currency crisis is simply the earliest full-scale example, a blueprint for collapse that has been followed again and again across centuries and continents. Fast forward to the 20th century and the echoes are deafening. After World War I, Germany faced crushing reparations under the Treaty of Versailles. The government printed marks to cover its obligations, thinking it could paper over debt, just as Rome had once struck more coins. By 1923, hyperinflation was raging. A loaf of bread that cost 1 mark before the war cost over 200 billion marks by the fall of that year. Workers demanded to be paid twice a day, so they could spend their wages before they became worthless by evening. People carted wages home in wheelbarrows, and stories emerged of thieves stealing the wheelbarrow but leaving the cash. Pensioners starved as their life savings evaporated overnight. Children played with stacks of worthless bills as building blocks. And just like in Rome, those who had debts found them wiped out by inflation, while those with real assets, land, factories, foreign currency, emerged stronger. Money became meaningless, and the economic despair fueled political extremism that set the stage for Hitler's rise. Zimbabwe followed the same path in the early 2000s, facing land seizures, falling production, and rising debts. The government turned to the printing press with abandon. By 2008, inflation had reached a mind-bending level, an annual rate of 89.7 sextillion%. Prices doubled every single day. Shops couldn't change price tags fast enough, so they simply stopped marking prices, quoting figures verbally that changed by the hour. The government eventually printed a $100 trillion note, a piece of paper that couldn't buy a loaf of bread. Eventually, Zimbabwe abandoned its currency entirely, forcing citizens to trade in US dollars or South African rand. Pensions vanished, savings evaporated, An entire population's wealth was wiped out. Once again, a government thought it could cheat reality. Once again, the people paid the price. But you don't have to look only at the extremes. Even in modern developed economies, the Roman pattern lives on, just in slow motion. Consider the United States. In 1971, President Richard Nixon took the dollar off the gold standard, severing the last link between currency and a tangible anchor. From that moment, the dollar became what economists call a fiat currency, backed not by gold or silver, but by trust in government and the phrase, legal tender. And just as in Rome, the temptation to spend beyond means grew irresistible. Over the following decades, debt ballooned from under $1 trillion to over $35 trillion today. Money supply expanded at rates that would have been unthinkable under a gold standard. Inflation became a constant undercurrent of economic life. While we haven't seen wheelbarrows of cash or trillion-dollar notes, we have seen a steady erosion of purchasing power that mirrors Rome's slow debasement. $1 in 1971 could buy what takes more than $6 today. The coins look the same, the bills look the same, but the value has been hollowed out year after year, decade after decade. The trick is always the same. Governments disguise inflation as growth. They tell citizens that higher wages mean prosperity, even as costs rise faster. They present debt as investment, even when it funds consumption and wars. They point to rising stock markets as proof of wealth, even when the majority own little or no stock at all. Just like the Roman emperors, they pretend that nothing fundamental has changed, while quietly extracting value from every coin, every bill, every paycheck. What makes this dangerous today is that the scale is global. Rome's collapse was an imperial crisis affecting the Mediterranean world. Weimar's hyperinflation was a national catastrophe. Zimbabwe's was a regional tragedy. But today, the entire world runs on fiat currencies, massive debts, and central banks willing to print trillions at the first sign of crisis. The 2008 financial crisis saw trillions created from nothing. The 2020 pandemic saw even more. Every major economy is now addicted to the same trick Rome used, creating money to solve problems that money creation itself causes. That means the next collapse won't be confined to a single empire or country. It will ripple across the globe, transmitted instantly through interconnected financial systems. And if history is any guide, the ones who suffer will not be the elites who hold assets, but the millions who rely on salaries, pensions, and savings denominated in increasingly fragile currencies. So what should you, as an individual, take away from Rome's currency crisis? First, understand that inflation is not an accident or an unfortunate side effect. It is policy. It is the deliberate choice of governments to tax citizens invisibly rather than openly. It is the silent tax that has broken empires for 2,000 years, and it is still operating today under different names and justifications. When you hear about quantitative easing or monetary stimulus, understand that you are watching the modern version of Roman debasement. Second, realize that real wealth is not found in paper or digits on a screen, but in assets that hold value when money does not. The Romans who survived the currency crisis were those who owned land, had skills, or held gold. Today, the principle remains. Real estate, productive businesses, commodities, and skills that others need will retain value when currencies fail. Paper wealth can evaporate overnight, but a farm still produces food, a skill still produces value, and real assets still have worth. Third, never assume stability is permanent. Romans in the 1st century would have laughed if told their coins would one day be worthless. They believed Rome was eternal. Germans in 1913 would have scoffed at the idea of wheelbarrows full of cash to buy bread. They trusted in European civilization. Zimbabweans in the 1980s thought their independence promised prosperity and stability. Yet in each case, the same story unfolded within a generation. The fall of Rome reminds us that financial systems can collapse slowly, then suddenly, as trust evaporates. For decades, Roman coins lost value gradually. Most people adjusted, complained, but continued. Then in the span of 50 years, the entire system collapsed. When money stops being real, society itself begins to unravel. Contracts fail because payment means nothing. Trade breaks down because trust disappears. Armies dissolve because soldiers cannot be paid. Governments lose legitimacy because they cannot provide basic services. The barbarians at the gate may finish the job, but the real killer is always inside the treasury. The empire defeats itself long before external enemies arrive. And here is the punchline. History doesn't repeat exactly, but if you don't understand its patterns, it will crush you all the same. The Roman currency crisis wasn't just about bad emperors or greedy elites, though both played their part. It was about the fundamental fragility of money itself when abused by power. It was about the temptation every government faces to solve short-term problems by destroying long-term value. It was about the iron law that you cannot create wealth by creating currency. And that fragility, that temptation, that law, none of them have gone away. The tools are different, the scale is larger, but the game remains the same. Somewhere right now, someone in power thinks they can print their way to prosperity, debase their way to solvency, or inflate their way out of debt. Rome tried, Germany tried, Zimbabwe tried. Each time, the people paid, and history recorded another lesson that the next generation would ignore. If this gave you a new perspective, hit subscribe. History has the answers, and I'll show you where to look.